Welcome students and traders, welcome back to the Perpetual Pip. Once again, this is your host, Will Gomez, and it's time to begin with our next educational lesson. For today's discussion, we're going to be talking about how to actually plot Fibonacci or Elliott waves. Now, again, we're just slowly but surely putting everything that we've learned together into a functional environment where we can actually identify what the market has been doing to be able to project what it will do. So hopefully during the course of this discussion, you'll be able to see exactly how a Fibonacci trend evolves. All right, so let's explore that here together. First and foremost, the big picture. This is not something that comes easy. All right, naturally it comes a little easier to some traders than others, depending on what your mindset is. If you're very spatial, then it won't be super difficult for you to kind of start to kick your brain into gear to seeing things like this. If you're not, though, it might be a little difficult. However, it is definitely not impossible, and it'll be our job here at Perpetual Pip to make sure that that's so. So again, if you have any questions whatsoever, don't hesitate to drop us a line ever. will@perpetualpip.com is my email, or perpetualpip@gmail.com. Either one works. It is going to be imperative to be able to track the rules that we're going to discuss here. So if you are one of my clients, then the chances are very high that you've already received this note. Worst case scenario, if you're not one of my clients and you're wondering what I'm talking about, look out for the actual ABCD Fibonacci rules in the comments section of this video. Okay? Now, when it comes to these rules, you'll always be able to reference them with this document that I've made available for you all. The first rule is going to be to begin at the origin of the trend. The reason why I highlight this, or why I stress this so much, is because most charting softwares, they have a tendency to bring you to the very current candle. And that's great if you're already analyzed and ready to go, ready to kick butt in the markets. However, when you are first getting ready and moving forward, right, once you have your analysis up to date, that's exactly what you're going to need. You just want to be paying attention to what's going on right here, right now, reference your analysis, and be able to make an entry. But at the beginning, it can be detrimental, especially for someone that's never looked at a chart before or never attempted to analyze a chart. So I do want to impress upon you the importance. It is imperative that you compress the chart as much as possible so that you can actually see the origin of the trend. Your view, your opinion will heavily be impacted based on what it is that you see when you compress the chart and see the whole picture as opposed to just the last few bars. All right, so please, please, please keep that in mind when you go about getting ready to perform your analysis. So here's a chart. This is a Euro-Aussie chart on a 2-hour time frame. Now, when it comes to performing our analysis, well, so far we've talked about how to draw trend lines, right? And determine trend direction. So we want to make sure that we do start with that. We identify the origin of the trend by identifying the lowest low and the highest high, and then we move on to drawing all applicable trend lines. Why am I hammering on about this? The reason why, especially as you begin, is that you want to have a firm grasp of what the actual trend direction is before you proceed to put your Fibonacci's on the chart and track the waves. So your trend line is going to be your best way to identify that. Get your trend lines on the chart. Once you have your trend lines on the chart, you are ready to start plotting. Now, I will say this again, and it's the same with anything. As you continue to develop or as you continue to expose yourself to these charts, to these markets, you're going to continue your spatial intelligence, if you will. Your ability to pick up patterns is going to continue to grow. So over time, it may not become as necessary to draw your trend lines. You might start to have a situation like me where I start to hallucinate the trend line, right? I can see it even though it's not drawn on the chart, right? This is something that's entirely possible. But between now and then, we want to make sure that we get off to a clean start. So I am wanting to encourage everyone to make sure you get into the habit of drawing your trend lines. After you compress your chart, you take a big view, a big gulp of the trend view with your eyes, observe whether or not there is an upward or downward slope, and then once you can see overall what the market seems to be doing, put your trend lines in to reflect that. And usually once you identify the highest high and the lowest low of the chart, it becomes very evident to just look between there to be able to identify the slope of the trend. So once you have that information, you're ready to start plotting. When it comes to the actual process of plotting though, don't get ahead of yourself, right? It's not a vote of no confidence as far as anyone's ability here, but in order to make sure that you are doing things correctly, right? You want to practice how you're going to play. So it is of extreme importance in order to make sure that you're accurate and so you can consistently capture profit moving forward. You want to make sure that your analysis is as accurate as possible. So don't skip any steps. As a matter of fact, what I would suggest is that you start to eliminate anything that is unnecessary for the task at hand. Don't be in a rush to get to the current market just so that you can jump into a position. Believe me, it's better to be out of a position and just, wishing, oh man, kicking yourself, I wish I would have participated with that, than to be in a position tearing your hair out. So just make sure that you're not skipping any steps. You've got to understand what the market has been doing so that you can, with confidence, attempt to project what the market will do. Why? Because the market's a creature of habit. It likes to do the same things again and again and again, just like the people that trade it. So once you've taken the time to determine the overall direction, again, eliminate all distractions. There's no need to be looking at the current candle. There's no need to be looking at the overall trend as it evolved. Just get to where you need to be to get started with your Fibonacci waves. And once again, here's that Fibonacci tool that we talked about before. We understand the retracement to extension relationship. As an example, I gave you a color code, right? If it goes to any one of the red retracement values, right, then it should be expected to go to the red extension value. If it comes down deeper to the blue, it should only be able to go to blue. And if it comes down deeper to green, it should only be able to extend to green, right? We're just following that bouncing ball. So here's that same chart, except what I've done is I've eliminated. Once I have my trend line and I understand the overall trend direction, then I know which direction, upward, bullish Fibonacci's I'm going to be drawing. So I'm just going to identify the origin, lowest low, and the first high, according to that rule document that you should have by now, to be able to plot my very first AB boundary. All right? Now, once I have that AB boundary, I can begin to track the actual Fibonacci phenomenon and watch it at work. Now, as we've discussed previously, the market tends to move in this A, B, C, D, or 1, 2, 3, 4, whatever you want to call it. It tends to move in this wave pattern. So, since we've already identified the AB boundary, then what should take place next is that the market should get ready to retrace or pull back for a C. Now, as far as what the C is, once again, if you reference those rules, and you should be able to use them while you can print it out. It's a downloadable document, so you can print it out and you can follow along while you watch this video. If you take a look at the next step, it says that C is always the nearest point to the A price after the B price, right? That's what the C is. And it doesn't matter what we're talking about right now. Although the examples that I'm showing you are that of an uptrend, the process is going to be the exact same in a downtrend or bearish market. The only difference is that you're going to be flipping everything kind of upside down. That's it. But in any case, when you're looking at the C retracement, relative to that AB boundary, that 0 to 100%, you're going to be looking to the nearest point to the A after the B. That's going to be your C retracement. So if we take a look at this example right here, here's that exact same, it's the same chart. I'm just zooming in to the relative portions, or the relevant, I should say, the relevant portions, to make sure that everybody sees this as it would have evolved if this had been current. Okay, now why? Again, because we want to practice how we play. When we get to the current market, you're not going to know what the future holds. All we do know is that the market tends to subscribe to this Fibonacci phenomenon. So when we analyze the market as if we're at current, even though we have our trend line drawn and we have a little bit of information about the future, following this process is really going to help you to kind of narrow down how an ABCD boundary evolves And more importantly, you'll be able to start to see the pattern and identify entry points, which we're going to talk about later on in future videos. So once we have that A, B boundary identified, the next step is to just identify where the C is, because based on that C retracement depth, we'll be able to project the D target. All we're doing is following that bouncing ball, right? Based on how deeply it bounces inside this AB boundary, we can predict where it will go, where it should go. So if this is my AB boundary right here, I've got my A, I've got my B, and based on the definition of the C, C needs to always be the nearest retracement after the A, the nearest point to the A after the B. So of course I'm not going to look anywhere in here for my C retracement. If I take a look at all the candles within and even without the AB boundary, I see that this is the closest price to the A after the B. So as of right now, this is the current C. Because of this retracement, the projected D target should be the 1.618. Now on this platform, I will go ahead and tell you right now, especially if you're looking at these values, they're a little wonky on TradingView, and I'm working with them right now. I have a subscription with them. I don't have any actual affiliation with them. I'm working with them right now to see if we can get this corrected. You have to actually reverse the Fibonacci's on their platform, but this won't be an issue for you across normal broker platforms. In any case, based on this retracement, the projected target should be the 1.618. All right. Now, with that said, that has to always be true, right? As long as that's true, the AB boundary will not change. It's a constant, just like I wrote in the rules. So there are only two actual reasons why the AB boundary would ever change. The first one is if the C takes out the A, and that's going to be cause for a reversal. What that means is if the market comes deep enough into the AB boundary to either touch the actual A price point or go beyond it, that's going to be considered taking out or invalidating the AB boundary and thus the trend that you've been tracking. So if that happens, we know it's time to change direction. We'll be talking about reversals in our next video. If the market, however, does not take out the A, then you have the second contingency to deal with, whether or not the AB boundary changes. If the D extension is hit and confirmed, that means a fractal. In an uptrend, you're looking for the D or expected D target to be hit and confirmed with a high, fractal high. In a downtrend, if you're tracking down ABCDs, you want that expected D price to be hit and confirmed with a fractal low, right? So once that happens, then you've got an ABCD wave being completed, and you'll be able to move on to the next AB boundary. The trend is evolving. If either of these two options does not occur, then the AB boundary is still in vogue. Okay? So if I take a look at this AB boundary, number one, I take a look and I see, well, this market has come really close to this line, but it's never actually hit it. So because of that, the AB boundary has not been fulfilled. I also see that even though it hasn't hit the D extension, it hasn't really come down any lower, which means it definitely hasn't taken out the A. So this AB boundary must still be true because neither of these conditions have been hit. Knowing these two things will also prevent you from making the mistake of maybe, oh, well, I see that this market moved to a new high up here. Why don't I relocate the B up here? Well, I wouldn't do that either because, again, there are only two reasons why the AB boundary would change. Either the C takes out the A, in which case I'm going to reverse, or the D extension has been fulfilled. Neither one of those have happened. We don't arbitrarily move the B boundary to another point just because the market has made a higher high. If we're using the Fibonacci to track the trend, then we need to obey the Fibonacci. And the Fibonacci is quite literally providing us with not only retracement percentages, but also exact price points, which let us know what value they are. Moving on. As I mentioned before, the C must always be the nearest point to the A after the B. So make sure that you are adjusting for C because that's a variable. That statement must always be true. C must always be the nearest point to the A after the B. So although at first this was the nearest point to the A after the B, the market then came down to give me a lower price. This becomes my new C retracement. And once again, based on that depth, I project which target it should go for. Lastly, when the D target is finally hit and confirmed with a fractal high, 2 to the left, 2 to the right, you've got a complete A, B, C, D wave. Once the A, B, C, D wave has been completed, we can now accept the fact that the trend is evolving. If the capital A had gotten taken out, I would look for a reversal. But since the D extension target was hit, I now know to move on with my next AB boundary. And the way that that works is my old C, that's going to become my new A. My old D, well, that's going to become my new B. And I'm going to be able to track a brand new A, B boundary. C becomes A, D becomes B, and we can now plot a new Fibonacci. All right, so hopefully this helps you to understand that the waves are definitely a natural phenomenon of the market. Now that I've got my brand new AB boundary, I can continue to track the evolution of this trade and see whether or not it's, not trade, excuse me, of the trend rather. I'm going to be able to track that and take additional advantages every time the market presents me with a new C and some sort of candlestick formation that indicates it's getting ready to move in the direction of the trend. This brings us to the conclusion of this Fibonacci video. I hope that this has been educational for you, and if you like what you see and learned a bit, feel free to give us a like and a subscribe. If you are making some progress and you want to put rubber to the road, trade alongside with us, feel free to join our live trading room at perpetualpip.com. This content is available also completely free on the tutorial section in the Learn to Trade button of perpetualpip.com. This has been Will Gomez for Perpetual Pip, and I'll see you next time for our next discussion. We're going to be talking about how to trade a market reversal. Take care.